helping home buyers become homeowners. Right now, we are in an information crisis. We are not in a housing crisis. As a certified mortgage advisor, it's my obligation, my duty and responsibility to provide factual certainty in uncertain times. But first, the primary purpose of this podcast series is to inform, entertain, and educate. The information, opinions, and recommendations presented in this podcast series does not constitute legal or other professional advice, opinions, or endorsements of any kind. Hello, my name is Kevin Martini, and I am a certified mortgage advisor and producing branch manager, NMLS 143962 with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446, Equal Housing Lender. Now, I am a certified mortgage advisor, and I'm proud of the highest designation that my industry provides. I am not an economist. However, I can provide valuable information to help the families that listen to this podcast, my referral partners that listen, the realtors, the financial planners, the CPAs, on what's happening and provide my opinion on what's going to happen. Again, this is just my opinion based on the data, and I have not recently stayed at a Holiday Inn Express. Again, the goal is, let me be clear, is very simple. I'm going to share data and ideas to help home buyers become homeowners. And I'm also going to share some ideas to help sellers get their homes sold fast. In a recent episode of the Martini Mortgage Podcast, if you already listened to it, thank you if you're a longtime listeners. If you're first to the show, welcome. But in this recent episode, I actually went ahead and said mortgage rates are transitory. However, home prices are always sticky. So before we start talking about the future, I think it's very, very important to talk about the past. So let's go in that DeLorean time machine real quick and talk about Arthur Burns. He was the Fed secretary, treasury, ran the Fed. And when he did that, he left in 1980. And during his tenure, the year-over-year inflation ballooned from 7% in 1978 to 14% when he left. Higher inflation caused mortgage rates to rise from 12 to 18%. In the Reagan administration, there was Paul Volcker, my hero. He increased the Fed fund rate from 11% to 20% in 2 years. Inflation dropped from 14% to 5%. Mortgage rates declined from 18%, can you imagine, to 12%. Then Fed speak himself, Alan Greenspan. Now, Greenspan did something unique. Inflation doubled from 1.75 to 3.5, and it caused mortgage rates to go to 7 to 8.5. But what he did is he matched the Fed funds rate to inflation, which resulted in inflation declining from 3.5 to 1%. Mortgage rates dropped from 8.5 to 5.5. Now, what do all three of these chaps have in common? They all created a recession. With Jerome Powell, will we see a recession too? Well, based on the minutes from the December meeting, they are talking about something called restrictive policy stance. And to me, this means they are not going to cut. They may not increase, but they're not going to cut in 2023. The next FOMC meeting will start on January 26th, and we'll see what happens on the 27th. There's no meeting in February, folks. Then the next meeting will have the results, that's right, on St. Patty's Day. I believe there's no soft landing, but I want you to remember, recession does not mean housing crisis. Now, a very accurate recession indicator to the Martini Mortgage Group is the inverted yield curve, which occurs when short-term treasury bonds have a higher yield than long-term treasury bonds. Think about it like this. If you're going to lend me money for 2 years, what rate would you think is fair? But if I wanted to borrow the money for 10 years instead of 2, wouldn't you think that that rate should be a little bit higher? An inverted yield curve is not just unusual. It is a leading indicator. It reflects that bond investors' expectations are for a decline in long-term interest rates. And that's typically associated with the R word, recession. Now, recession is not a bad thing. In the modern history, which I'm going to define as the Reagan administration, there were 6 recessions. In 4 out of the 6 recessions, home values went up. Now, obviously, the Great Recession, there was a significant decline. However, the events that occurred are not being able to be rinsed and repeat because of the quality of borrowers today. So if we take the Great Recession out of it, 4 out of the last 5 recessions, home values went up and just negligibly down during the one in the early 90s at that point. Again, as we're right now thinking about the market, we need to take a look at, listen, there's servicing value issue right now, but for almost a half a century, the 30-year fixed mortgage has moved in unison with the 10-year treasury. Generally speaking, on average, there's a 1.7% spread difference between the two. Right now, the spread is significant. It's 2.07. Now, as the Fed gets inflation under control, as the long-term rates come down, you're going to see this more to a more stabilized market. And this will create better opportunity. But right now, here's the deal. The people servicing the loan know that it's not if the person getting a loan today is going to refi. Well, it is if they're going to refi. It's a question of when. So I will share with you in the last 6 recessions that have occurred, every time from peak to trough, there was a decline in mortgage rates. On average, mortgage rates dropped 2.35 percentage points from peak to trough. Now, here's the thing. I'm going to say this again. We're in an information crisis, not a housing crisis. And the problem is headlines are designed to scare the heck out of people because news organizations write headlines so you click. They stay so you watch the commercial. Now, I'm not saying they're factually incorrect. I'm saying they don't tell the whole story. They just tell a headline that's catchy, and in Mike's type, they'll tell you something else. Diane Olick is CNBC's senior real estate correspondent. Great lady, great information. But let me just highlight her for a second. In 2015, October, she wrote a bubble larger than 2006. She was wrong. In August of 2016, she wrote, we're in a new housing bubble. She was wrong. Homeownership doesn't build wealth, she said in November 2017. She was wrong. And then she says it's better to rent than to buy in September 2018. She was wrong. Then she said the housing market is about to shift in a bad way for buyers. She was wrong. She then said next year will be hard on housing market, especially in these big cities. She was wrong. Then she said in July of 2021, housing boom is over as new home sales price fall to pandemic lows. She was wrong. No, all due respect to her. If you listen to her advice, in October 2015, the average home was $300,000. At the end of July 2021, that same average home was $523,000. If you listen to the headlines, it would have cost you as a home buyer $250,000. Well, actually, $223,000. Listen, facts matter, and facts don't lie, and they help people take action. So let's look at the facts real quick. The story that no one is talking about is the fact that, yes, there is a shortage of inventory of homes for sale. if you compare the average of 2.5 million to a little bit north of 1 million in today's market, we're a shortage. Plus, there are new housing formations, the most that we've seen in a long time. And what a housing formation is when a parent has a child, the child leaves the house. That's a housing formation. Doesn't mean that they bought a house or they might be renting. It's still a housing formation. If those parents got separated or divorced and one of them moved out, that would be a housing formation. You see, the supply and the housing formation is why billionaires are right now buying up single family houses. It's an opportunity. Jimmy Dimon with Chase, $1 billion in single family homes. Jeff Bezos is buying them too. I get it. Rising mortgage rates are a product of inflation. And in 2022, inflation impacted mortgage rates, which impacted affordability. For crumb's sakes, if you look at January all the way on the left to December all the way on the right, it nearly doubled in actual mortgage rates. But I'm reminded of the Oracle of Omaha, when he said this: be fearful when others are greedy, and be greedy when others are fearful. That's why the billionaires are buying real estate right now. Now, again, I'm not an economist, but the indicator on how inflation is doing, and inflation is very important because inflation impacts the bond, and bond is where mortgage rates live. The indicator that the Martini Mortgage Group uses is core CPI because it takes out the very volatile food and energy segment. Now, what's important to know is that it is a measurement from the same month a year ago. So recently we had an inflation reading for November that came out. And when inflation came out for November, it was 0.2%, and then it replaced the 0.5, hence inflation went down as long as in the core CPI. So the real question comes, what's going to happen on January 12th? Well, the previous reading is going to replace as 0.6. The last 2 months were 0.3, 0.2 in core CPI. So a high probability inflation's getting under control. What the Fed is doing is working. Here's the challenge. The Fed tends to come to the party a little bit late, and they tend to stay a little bit longer. They've clearly indicated they're staying at this party all year. So here's the thing I'm going to ask you. It's not just possible. It is likely that mortgage rates could start with a 4 by sometime in the end of 23 to beginning 24. Personal opinion, I believe it's sometime in 2024. And you know what? Lower mortgage rates will cause real estate to skyrocket and make it harder for buyers to get in. Right now is an opportunity. Again, the Warren Buffett said it great. Be fearful when others are greedy, and greedy when others are fearful. You see, I don't believe one person's opinion on where home values are going to be going. I look to something called the Home Price Expectation Survey, which is done by Pulsenomics. It's not one person's opinion. It's a panel of over 100 plus market movers, economists, real estate segment experts. And they're asked this question: where do they think that real estate's going to go from where we are today to the end of 2026? Now, there's segments of people that are the bears. These are the people that are saying, oh no, the sky is falling. Well, guess what? Those people think that home values are going to go up over 8%, close to 9% between now and the end of 2026. Then there's the guys that are the bulls. You know, these people are running with their shirts off, banging their chest, and they say, hey, listen, we're going to be north of 40%, actually 43.7%. But if you look at all panelists, take the bulls out, take the bears out, it's very simple. The average is about 24.6%. So essentially, a $400,000 house purchased today, based on the home price expectation survey, could be worth about $500,000. $100,000 of equity between now and the end of 2026. So let me ask you this. Are you open-minded to a strategy that would, if I would share, that could make a home more affordable for you? I am not talking about an ARM. Now, let me just tell you this. At the end of the day, many buyers have vivid memories of ARMs and the absence of safety and security they provided, where a 30-year fix does provide a massive value. Yeah, I believe that rate's going to go down, but I can't guarantee it. So with an ARM, it's not a question of if you have to refinance. You will be forced to refinance. But you know what's really worse about that? You might miss the opportunity to miss the refinance, and we might slip into an Armageddon. Perhaps the opportunity presents itself and you don't qualify. Then you have an ARM that is going to go potentially up, up, and up. An advanced strategy that is working today. Home buyers today want to purchase a property that's properly priced with a seller paid buy down. Now, let me ask you this question. Why do they want to do this? It's simple. A seller paid buy down is a benefit now and a benefit later. You see, an ARM has no long-term benefit, or adjustable rate mortgage has no long-term benefit. And if you think about it, the only benefits to a seller. In addition, a seller buy down strategy is, are you ready for this? A seller buy down strategy is 300% more effective at improving affordability. So let's talk about buy downs. They come in 3 different flavors. There's something called a 1-0 seller paid buy down. This is where a seller pays a fee at closing to reduce the interest rate on the home buyer's mortgage by 1% in year 1. Then there's the very popular 2-1 seller paid buy down. In this strategy, the seller pays a fee at closing to reduce the interest rate of the buyer's mortgage by 2% in year 1 and 1% in year 2. Now, it's available, but let me just tell you this. It's like finding a leprechaun riding a unicorn. But there is something called the 3-2-1 buy down. And with the 3-2-1 buy down, the seller pays a fee at closing to reduce the interest rate by 3% in year 1, 2% in year 2, 1% in year 3. It gives them time to get that refinance window. It's an amazing opportunity. The other opportunity is a seller pay down offers a buyer near money. Now, what is near money? Near money means having access to an asset that can be converted to cash. This is because the amount of the seller paid buy down gets put into a custodial escrow account. And every month, a little portion of that money from the custodial escrow account gets taken out to pay the difference of the lower payment that the home buyer will get during their period of time. Now, when that home buyer refinances, when that home buyer sells, if there's any money left in that custodial account, it's near money. The home buyer gets it. Now, we talk about rates. Let's look at the bellwether, which is the Mortgage Bankers Association. They're predicting by the end of 2023, the 30-year fixed rate is going to be 5.4%. But look at 2024. Look at 2025. It's 4.5%. Now, before the Fed statement, I would have said that this was a little bit aggressive, but now it might be a little bit conservative. But I do think that the time period is 2024 for the rate to start with a 4. So let's take a look at a buy down strategy at a high level. With a buy down strategy on a $500,000 house, you're going to see that your payment would be at a rate of 6%, would be $2,856 a month. Now, sometimes a seller has to do a price reduction. So if a seller did a $1,000 price reduction, your payment would only go down $143, a little bit less than $143. But look at the power of a 2-1 buy down. It's massive. It's what I call a win-win scenario. Because with a 2-1 buy down, we're not getting all the money from the seller, but the seller is participating. And you're getting a first-year benefit of $488. That means you're buying that $500,000 house and is essentially feeling like a house a little bit less than $400,000. This resolves the seller paid buy down, resolves all affordability concerns. Would you agree? You know, what we do at the Martini Mortgage Group at Gold Star Mortgage is pretty much basically what we do is pretty much essentially what everybody should do. We offer great rates and we close on time. Can't really brag about that because that should be the minimum standard you should get from any lender you're working with. What is the difference between us is how we do it and why we do it. I truly believe, and I have confirmation, it's easier to make $1 million in real estate than it is at your 9-to-5 job. I'm dedicated to the success and the generational wealth creation for my clients. And if you want trusted advice, I invite you to give me a call. For some great information, check out the Winter 2022 edition of the Martini Buyer Guide by going to martinibuyerguide.com. I mean, it is just packed with some killer information from what's happening in the market to things, to 5 traps to avoid, things to avoid after you apply for a mortgage. So check that out. My name is Kevin Martini, and you can reach me by dialing 919-238-4934. I know how precious time is, so thank you very much for taking the time to watch and listen to the Martini Mortgage Podcast, episode 169. Folks, right now, it is an opportunity, and there are ways that we can help home buyers become homeowners. Thanks for listening. Peace and blessings.